Here we go. Welcome to our second Money Talk Tuesday. This week's structure or topic, I'll say, is the CARES Act and your retirement, featuring the president of the Financial Planning Association of Massachusetts, Brad Wright. What I'm going to do is go through the quick little agenda. So we're gonna work through a little bit about what the Office of Economic Empowerment does, our disclosures, and then I'll introduce Brad and we'll get started. So the Office of Economic Empowerment is a department within the Office of the Treasurer and Receiver General of Massachusetts. We're tasked with supporting, advocating, and facilitating policies that empower all Massachusetts residents. Our programs serve women, families, high school students, veterans, and seniors. And our priorities include closing the wage gap, increasing access to financial education, improving college affordability, and investing in STEM careers and education. Just so you guys are all aware, this Zoom is being recorded, and the recording will then likely be uploaded to public websites, our public websites for future use. We're also streaming live on Facebook. So if you follow our page of the Office of Economic Empowerment, you should see us pop up. Feel free to share. And then any information gathered or shared through the question functions, this anonymous, but note that the chat will be recorded and visible afterwards. So it's subject to public record laws, and so that part of it won't be anonymous. So like I mentioned, this is a webinar, not a meeting. So everybody who's entering and attending, you'll only be able to see the panelists, and you won't be able to view each other. The host, meaning myself or Brad, can call in or on participants to answer questions. There's a chat feature if you're using your app, your phone, or a laptop, some kind of desktop. You'll see on the bottom that there is an option for Q&A or chat. Both will be available throughout the entire webinar, and this is where you can place your questions. I'll be monitoring the chat box and the Q&A, so as we get them, we'll try to address them as soon as we can. We'll also be having a poll that you can participate. Again, if you are on the app, on your phone, mobile device, laptop, you'll be able to participate, but if you are calling in, you will not be able to participate. And then finally, please complete the post survey that we're going to send out to you guys so that we can continue to improve this program. We do include an option for folks to give us feedback, to suggest new topics for upcoming Money Talks, and just give us overall general feedback. So thank you. Like I said, we're on Facebook, and you can submit any questions or ideas to moneytalk@tre.state.ma.us. So without further ado, I will send that over to Brad to get started.
Thank you very much. Thank you, Shai. Thank you to the Economic Empowerment Office for inviting us to help host these Tuesday Money Talk series. Thanks to also to Kristen Bean, who's the Executive Director at our Financial Planning Association of Massachusetts. As Shai mentioned, I'm the president this year of our local chapter. The Financial Planning Association is a national organization having about 25,000 people. Our local organization has around 900 financial planners here in Massachusetts, and really we are financial planners who have come together to do exactly this sort of a thing, to educate, to collaborate with the state and other organizations, and to advocate when necessary too, for both members and the public. I'm also a practicing CFP, Certified Financial Planner. I'm doing that from home these days, as I think everybody is mostly doing everything from home these days. I contribute to the media, so I'm one of the financial experts on Channel 5 TV here in Boston, and also periodically you can hear me on Mix 104.1 radio as well. I'm also a dad, trying to balance work and kids and extended family, and you know, the kids are on spring break this week, whatever that means. So if you hear any kind of crazy noises in the background, really that's what it is, lunchtime in this household. This hour is really, it's going to be more of a discussion, more of a conversation versus a presentation. I'm not going to show you slides or anything like that. Really, you can post up questions in the chat. If I don't see them, Shai will hand them off to me. You can ask questions now, during, after. There'll be plenty of time. The way we've sort of structured this is it's an hour, you know, it's from 12 to 1. I'll have enough prepared comments to cover about half of that, and we'll leave plenty of time to ask questions too, but feel free to ask as we go through the different topics as well. And there'll be many resources. There are websites I'm going to give you, and I'll repeat them all at the end. I will we'll post them too, and this is being recorded, so you can go back and get them at any time as well. A lot has changed over the past 2 months, definitely regarding health with COVID-19, but also with businesses. You know, some small businesses are reluctantly shutting down, but you know what? There are going to be positive changes going forward from here too. We will heal, we will grow again, new businesses will emerge, and you know, it might be a little bit of a new world order, but you know, we're resilient and we will get past this. All health crises, you know, in the past we've gotten through. That will happen again, and it remains to be seen when that will be, and you know, the long-term effects. But we will get through it, and our focus right now is really it's the current environment. It's how do we get from point A to point B, wherever that point B is going to be. That's the unknown, but there are certain things going on to help us get there. You know, we're working from home, so everybody, mostly, not, you know, I have a brother who's a firefighter. He's not working from home, can't work from home. But you know, a lot of people are working from home, so that's a different environment. Some people obviously have lost jobs. Some people have gotten sick. Hopefully those people are on the mend and getting better. Everybody's homeschooling, which has its own challenges. But the government has jumped in and offered assistance, and that's really what we're here to discuss today. So it's the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act, shortened to CARES Act because I can't remember the long version either. It was put into effect, signed into effect March 27th, and how it impacts your retirement is what we're really here to discuss. So the CARES Act is going to affect different people in different ways, and it sort of depends, you know, where you are in your life's journey at this point as to how it can affect you, whether it's immediately or sort of intermediate term or long term. And I think the best way to really kick this off is by doing a poll so we can find out where you all are who are watching this in the scheme of your life's journey, really. So the first poll question is going to be, which of the following statements best describes you? And the choices are going to be, I'm currently retired, I have less than 5 years until retirement, or I have more than 5 years until retirement. So Shai will post the poll. We'll give you a minute or so to respond. And basically this is to help structure what we're going to talk about over the next hour. We're going to cover any of those three categories that you happen to be on, but you know, if it's weighted one way over the other, we could maybe, you know, pivot a little bit and focus more on that. But it'll be good to know because, you know, if you're currently retired, you want to know where the money's going to come from. If you have less than 5 years, you want to know, should you contribute or, you know, should I change some things? And, you know, if you have a longer time horizon, a longer runway, then maybe it means something different for you as well.
I have a question if you want to answer it while we're waiting for the poll.
Sure.
Do you anticipate interruptions to retirement benefits, public and private, as a result of the pandemic?
I don't anticipate interruptions. I think if you're getting, well, so private's different. Private, you know, in a lot of cases means you have a 401k or a 403b, and that's sort of based on what you put in, what's coming out. So, you know, as your account fluctuates either up or down, that could obviously play into how much money can come out. But I don't see, I haven't heard anything about anyone stopping benefits coming out to retirees, if that's the question. Companies have stopped matching. So as you're putting money in, And companies, some companies match what you put into your 401k or your 403b, et cetera. And some companies have stopped or at least paused doing that for the time being, but it shouldn't affect what's coming out at this point. So oh, there they go. I see the results. All right, so it looks like the majority have more than 5 years to retirement. So you have a longer runway for, as much as this seems like this is going on for 1,000 years, it's not, it won't, and you have more time to recover. And then currently retired sort of came in second with 20% or so, and then less than 5 years in retirement. There are some people, but even less. Okay, so more than 5 years to retirement, and really probably everybody right now is talking about the stimulus check. So we'll start with that. They've begun arriving. If you haven't received it yet, it's funny, I just received something from my bank the other day that basically says, hey, it's not on us if you didn't get it yet, it's on the IRS. Which is true. I mean, they will direct deposit into your bank, but the IRS has to know who you are and they have to know how to find you. They have come up with different ways. If you haven't needed to file tax returns in the past couple of years, there are now portals on the irs.gov website for you to tell them who you are. But basically, you could get $1,200, $2,400 if you're married and you haven't been phased out. The phase outs for single people are between $75,000 and $99,000 in your adjusted gross income, which means, all of your income minus your front page deduction get you your adjusted gross income. If you're married filing jointly, the phase out for your adjusted gross income is $150,000 to $199,000. So if you're over either $99,000 or $199,000, depending if you're single or if you're married, you will not be getting a stimulus check. If you're under those amounts, you'll be getting either the whole or some form of that amount, either $1,200 or $2,400. Plus dependents for your kids under age 17, you could also be getting $500 per dependent. So retirees also receive the checks. I receive throughout the day questions on that. Yes, you get it. IRS.gov is a good resource for that. I went on there this morning. They put it right on the front page. One of the links you can click on is Get My Payments. And another one is Get Your Refund Status. So if they don't know who you are, go to Get My Payment and tell them who you are. If you haven't yet received it, you can check on your status on there as well. So they should be coming, they started last week. Some people have received them, some have not. It's going to take them a few weeks to roll it all out. So I wouldn't worry yet if you haven't received it. But then the question comes up of, what you should do with it. And, there are a million things to do with it. But since the unknown is, we don't know when this is going to end, and I don't always suggest going out right away and spending it. An emergency fund is always good to have. If you, a goal should be somewhere around 6 months of an emergency fund. So if a medical bill comes up, if you do get sick and you have to pay something, home maintenance, your hot water heater goes out, it's still spring, we need the heat, and you need to repair that, this money could go towards that. Beyond an emergency fund, if you have high interest credit card rates or high interest loans, you could pay some of those down. Although, ironically, we would always say as financial planners, pay those off as soon as possible. But in this day and age and era of what's going on, depending on how much you have, at least be paying the minimum, at least be paying so that you're paying it down. And it's different for everybody, so this shouldn't be taken for specific advice more generally, but there may be cases where it's not, you can't pay it all off right now, and that's okay as long as you're paying the minimum, as long as you're paying some to try and get it down. And if you're building up the emergency fund too, that kind of works. If you don't need it, save it. You could put more into your retirement account. You could, you could give it to a charity if you sincerely don't need it. I've heard of some people going help out small businesses that they'd like to see still around, at the end of all this, and patronizing them, which is a good idea. Education, whether it's for yourself to get yourself better for whatever is next, if you lost your job or if you're thinking about changing jobs. There's inevitably going to be a question about, saving for education for others. I would say, yeah, that's a possibility. But something to keep in mind that we usually tell people is, you can always borrow for education if you need to do that somewhere down the road. You can't borrow for your retirement. So make sure your retirement is shored up. And if this stimulus check is going to help you head down that road to save for retirement, then all the better. And we are going to talk about a little further down how this will affect retirement and retirement accounts and different options in your retirement accounts. But before we get there, you're getting this money in. Those are some options to do with it. But what if you have debt? What if you have debt and that check is not enough, or you have been furloughed, or you have been laid off? What can you do, and are there services to help you with that debt? And yeah, there are, depending on what the specific debt is that you have, which will bring us now to our second poll, which is going to ask, do you currently have any debt? And you can select all that apply here. So student loan, mortgage, credit card, medical, etc. Because I rarely come across anyone who doesn't have any sort of debt at some point in their life, and it's all about how you handle it, when you handle it, and the variety of ways that you can get help to get out of it.
I have another question.
Yes, go ahead.
All right. So it says getting the stimulus package regarding $500 for each child.
Yep.
If they turn 17 years in 2009, are you able to collect the $500, or is it age 16 and under? Please clarify.
Yeah, well, so once they turn 17, they're not eligible anymore. They turned in 2009, or must have been 2019.
19, excuse me.
So yeah, so once they hit 17, unless once they're independent and filing on their own, they could apply for their own stimulus check. But yeah, once you hit age 17, it's the same as the credit you get on your regular taxes, so that they'll become ineligible. Okay, so any debt is what we're looking at this point, and it looks like mortgages take the lead. Credit card debt and student loans seem to be pretty close to each other, and then medical is behind that. Medical is pretty low actually there, and then other and none. So let's go through we'll go through each of them quickly. And really, the common denominator for any outstanding loan that you have is, if you're in trouble or you anticipate being in trouble and paying any of these back, call before you're in trouble. Get in touch with any lender that you do business with. You probably received emails from the majority of them in the past couple of months. Call them before you're in trouble, because keep in mind, they're all working from home and they're all short-staffed, and it may take a while to get through and to get answers. And you want to do it before you're on the other end, before you're owing a month or two down the road and they're looking to collect. So call and try and get ahead of the game. So for student loans, specifically the federal loans, the direct loans and the federal family education loans, the payments are suspended the government has suspended them from March 13th of this year through September 30th of this year. So they're suspended, and they're suspending the interest, and you shouldn't be required to pay federal loans. Now, if you have the private lenders or different kind of loans, those are not included, and you should talk to the different lenders about that. But the federal loans have suspended them through September 30th. Mortgages all handle it differently. I know I received something from my mortgage lender saying, if you're in trouble, call. And some will suspend it suspend your payment for a couple of months and suspend the interest. And then what happens varies, right? So some could add this on if you have a 30-year mortgage. Some could add this on to the end of your mortgage and extend it. Some could 2 months from now be expecting a lump sum payment of the interest of the principal or both. There are different ways that different mortgage companies are handling it. There's no strict rule or rhyme or reason for them doing this. So call them and just inquire. Credit cards, you can always, not even just now, but always you can call and ask for a lower rate if you're in trouble with your credit card. You can ask them for a payment plan. And the goal is to, again, get ahead of the game before you end up in arrears. And then, so should you have to continue paying these loans, which in some cases you will, where can you get the money if the stimulus check is not enough? Can you borrow from your retirement accounts? Yes, in most cases, the answer is yes. Before this COVID-19 hit and before the new CARES Act came into play, you could borrow from, if you had a 401k or if you had a 403b, you could borrow up to $50,000 or half of your total account value. But now they've waived, they've upped it to $100,000 and they've waived the other choice, which was 50% of what you have in it. So as long as you have $100,000 in your retirement account, you can borrow it. Now, it's not my recommendation to borrow from your retirement account, and we'll get into that. But you can if you need to. And now it also includes IRAs. So before you could not borrow if you had an IRA. It does include IRAs now. So the requirement is that you've been adversely affected by COVID-19. So whether you've been sick, your spouse has been sick, your dependents have been sick, you've lost your job because of this. I think it even goes as far as, your kids are home and you can't work and you have to take care of them. So basically it's up to your plan sponsor to determine if you're adversely affected or not. But basically, if you're facing financial adversity because of this pandemic, it should qualify you. And the rules are you can borrow up to $100,000. You need to pay it back within 5 years in substantially even payments, which means you just can't wait to the end and pay a lump sum payment. You pay interest, but keep in mind you're paying interest yourself. And the interest, the rule for that is it has to be a market interest rate. So, and that's right around 5% right now. So basically you'd be paying yourself a 5% interest rate. And you have until September 23rd of this year to take advantage of this, not to borrow it and pay it back, but to decide, yes, I'm gonna borrow money from my retirement account by 9/23/20. It's the deadline to take advantage, or it reverts back to the original 50,000 or half of what's in your account. Again, borrowing from your retirement account to me is sort of a last resort, but it is there for you if you need to do that. Shad, do you have a question?
A couple questions.
Yeah.
This first one is about loans, and it's specifically about car loans.
Okay.
Can I request a lower rate on my car loan, or will I need to apply for a newer rate?
For one that's already in effect, I'm taking it. Yeah, I mean, if there's already, if you already have the loan, you're, I don't know, 3 years into a 5-year loan with your car company, you would need to refinance that loan to get a lower rate. But I will say, the Fed has been lowering rates. So if you're looking to buy a car right now, you could probably get a pretty low rate. And I think, cars are not selling right now either. So if you were planning to buy a car, you had that money set aside to buy a car, and you were looking to do that now, no matter what, it probably is a good time to inquire about getting a good deal. But any loans in existence, whether it be your mortgage, whether it be your student loan, or whether it be your auto, they're not likely to just lower the rate unless you refinance. But again, they could, any of the above can suspend payments for you in this time.
And then another question, this is back about the stimulus check. My daughter is a full-time college student who worked during the summer, but I claimed her in my taxes. Is she eligible for a stimulus check?
I'm assuming that means she's 18 plus. So no, if she is claimed on if she's your dependent, and she doesn't just claim herself, then she won't be. But if she were to be independent, this year going forward, then, that could change.
I got an update. I don't know if it changes the answer. So that she's 21.
Okay. Yeah, if you're claiming her, then she's going to have to, she has to be an independent tax filer and be claiming it on her own. Which brings up unemployment too, by the way, because if you're unemployed because of coronavirus, first of all, file for unemployment. Go to mass.gov. And again, they've updated their website. They've made it super easy. There's a lot right on the front page. If you go to mass.gov, you can immediately go over to the upper right and click on COVID-19. And then get help along the left side after that. And it has everything on there. It has how to apply, how to get your status, how to do all of that. The federal government is also throwing in an extra $600 per month for 4 months on top of state benefits. That's going to come in 2 different checks, by the way, because people are wondering, well, how come my check's not increased? The federal government is going to send you their money separately from the state. But mass.gov, click on COVID-19 and you're able to file for unemployment, and you're able to get a lot of unemployment questions by the state of Massachusetts answered on there as well. So poll 3, the third poll question is just to find out a little bit about what kind of retirement accounts and savings plans that you do have. Because again, there are slight differences depending on what you have. So do you have any of the following retirement savings accounts or pension plans? And you can select all that apply. So it's going to be 401k, IRA, including Roths, pension plans, other, or in some cases you don't have any. So that's the poll question that Shai should put up for you there. And again, it depends. Previously 401ks and 403bs you could borrow from, but now IRAs are included too. And Shai, do you have a question you want me to answer while they are filling out this?
So far, no. But if people have any questions while you're waiting for us to finish the poll, you can pop them in the Q&A box at the bottom. Just repeating in case phone call-in listeners are listening, we are soliciting questions in our question and answer. If you have the app, you can submit it through the app.
Nice. Technically advanced here with the app. That's good. Okay, again, so what kind of retirement savings or pension plan do you have? And the options are up there.
Okay, we got a question.
Okay.
Is the extra $600 federal unemployment benefit per week or per month?
Per month. So it's per month for 4 months. So it could be an extra, $2,400 overall from the feds on top of whatever you're getting from the state.
Does my 401k plan have to allow for the COVID distribution?
Unless they opted out of it. So all plans, it was sort of a negative response letter. Sometimes you get those from different businesses. Hey, if we don't hear from you, we're assuming this is a go. It was the same sort of thing with retirement plans. So every company was sort of sent the opt-out letter, and they could have opted out. I haven't heard of any plans that have. So I'm assuming that most plans are in on this and should allow this distribution.
When do you think we will know if the SBA loans will get additional funding?
Yeah, they're working on that now. I keep hearing today, tomorrow. They're working on the fine print at this point. I think everyone anticipates there's going to be more funding. I would assume they're going to make that decision soon, but I don't know for sure.
Getting federal tax refund by check. How do I get the stimulus money deposited?
So they're going to send it to you however you normally get your tax rebate. So if you have like I have my bank account synced up with the IRS. So if I owe, it comes right out of my bank account. If they owe me, it goes right into my bank account when I file. But if you don't do that and they send you a paper check refund, you'll get it that way.
All right, so I'll end the polls here.
Poll results. Most people have an IRA versus a 401k. Some people have government pensions, a bunch of others, and some not at all. So it looks like IRAs are the most. So let's talk about, we talked about loans from your retirement accounts. So now we're going to talk about just outright distributions. So there's a difference. Loans you're going to pay back. Distributions, you're not. You're keeping the money from your retirement account. So if you're retired and you're in RMD status, which is required minimum distributions, that means every year you're required to take a certain amount out of your IRA, 401k, pension plan, etc. That is being waived this year. If you're not in RMD status, so usually the rule is until you're age 59 and a half, if you take money out of your retirement account, you're going to be paying ordinary income tax, federal and state if you have it, which obviously Massachusetts does, plus a 10% early withdrawal penalty. So right now, the 10% early withdrawal penalty is eliminated for coronavirus related distributions. Again, if you're financially affected, and it's up to the plan sponsor to sort of decide that, to be the judge. So if you're adversely affected, the 10% early withdrawal penalty is eliminated. And you still have the option to repay it over the next 3 years. So again, it's not a loan, it's a distribution. A loan, you need to put back sort of equal payments, at least quarterly over the next 5 years. Distribution, they anticipate you keeping it, but if you decide, a year from now, I can afford to put it back in, you can. You have up to 3 years to put it back in. It doesn't need to be even payments. You can just do one lump sum at the end, as long as it's within the 3-year window. If you want. But the 10% penalty for under 59 and a half, age 59 and a half, is going to be waived for this year, for 2020. And your required minimum distributions, if you are required to take them, that is waived for this year. So any money that you're required to take out of your retirement account, you do not need to take. Now, some people are going to say, I already took it and I've already paid the tax. So what do I do now? Well, there are some options. You may be able to roll it back in. There's something called a 60-day rollover. So if you've taken that distribution in the past 60 days, you may have the option to roll it back into the same account that it came out of. But you do not need to take it. So if you don't need to take it, there are other options as well, right? So if you're depending on your retirement account for cash flow to live throughout the year, what can you do? Well, if you have a taxable non-retirement account, a savings account somewhere, maybe you could take money out of that for this year. If you're getting Social Security, that's another avenue for cash flow. How do you know if you should claim Social Security is one of those questions where the answer is always, it depends. Depends on a lot of things. If you're single, if you're married, if you're healthy, if you're not healthy. There's always a break-even age with Social Security. So you could take it as early as age 62. You could take it at your full retirement age, which would be, depending on when you were born, age 66, age 67, somewhere in there, which would give you a little bit more benefit. Or you could wait till age 70, which would give you the most benefit. So there are decisions to make throughout that age bracket there. Know that the longer you put it off, the more money you're going to get every month and over your lifetime, as long as you're healthy and planning on living, a decent amount of years. So there is a break-even age. You can run that. It tends to be late 70s, 80 years old, somewhere around there. So if you anticipate living longer than that, it makes more sense to wait. Also, if you have a spouse, you can do some things where one spouse can claim, one spouse can wait, that sort of a thing. But again, I can't give specific advice on that at this point. Also you can reduce expenses. I know a lot of people have talked about this. Any memberships you're not using, gyms are closed. Any other kind of memberships that you're not using, maybe you put that on hold and save that money. Your phones, we're not out, we're not roaming around, we're not using, especially if you have internet at home, we're not using as much data. So maybe you don't need a big data plan on your phone anymore. We're not driving, we talked about buying new cars, but if we're not driving as much, partly your insurance rate, your premium is based on how far you drive. So if you're not driving as far anymore, you call your insurance company because they may be apt to reduce your premium. So you can, we've talked about 401ks, 403bs, and IRAs. Also, any deferred comp plans, certain qualified annuities and pension plans, you can also take distributions from in this environment. It's penalty-free distributions. Again, if you're under age 59 and a half, up to $100,000. So, you can't take more than that out, but you can take up to $100,000. You will pay tax, but you won't pay the 10% penalty. And the thing with the tax is it's ordinary income tax, but you can pay the tax over 3 years. So instead of paying it all on next year's tax return, you can pay it over 3 years, which may help keep you in a lower tax bracket. Or you can pay back the full amount within 3 years and end up not paying any tax. Shai.
Hi again.
Hello.
So we have a question about the required minimum distribution. What about the required minimum distribution you received in January through April?
Yeah, because you don't need to take it at this point. So, so April, go back 60 days. Somewhere the amounts that came out, maybe February, depending on when you got it, February, March, April, you may be able to put those back in as part. It's called a 60-day rollover. So you essentially call whoever the plan provider is and say you'd like to put it back in, and can you do a 60-day rollover? So you should be able to roll it back in, and then it will not count as coming out, and you won't owe the tax on the amount that goes back in. Anything prior to that, if it came out on January 1st, it may be too late to put it back in at this point, but you can stop them going forward for certain because you're not required to take them out. Not saying you can't take it out. I mean, if that's your cash flow and you need it throughout the year, you need it and you should keep taking it. But if you don't need to.
And then another question. The IRS website says payment status not available regarding stimulus check. Based on our income, we should receive a portion of the check. This is based on 2018 income. Mm-hmm. Would we still need to file 2019?
Well, you still need to file your 2019 taxes, but the deadline is now July 15th for that. So here's the thing. Yes, if you haven't filed 2019 taxes, they're going to base your stimulus on your income from your 2018 taxes. So if you qualified with the 2018 taxes, but perhaps you wouldn't qualify with the 2019 taxes, then it's to your benefit to take the allowed delay and not file your taxes until after you get the stimulus check. And the reverse could be true. So in this instance, I think you said they are going to get a partial amount of the stimulus check. So if based on 2018 taxes, you're getting a partial amount, but if you were to file 2019 taxes, you would get more money or a better amount, then it's more of a benefit to file your 2019 taxes. So they'll base it on whatever they have is really the answer.
Would you know anything about why people might be struggling to see their payment status on that IRS website?
I think it's probably because it's new and they're probably still trying to track, what went out and who is still pending. I think that's also a recent addition to the website. So I'm not sure why it's not working, but I would, if it's going into your bank, I would check with the bank and see if it showed up. And then if it's, if another week goes by, you can inquire, I think, on the IRS website too. And again, it may take some time for somebody to get back to you, but put in an inquiry and find out where it's at. So again, if you're taking the penalty-free distributions from your IRA, you can pay it back within 3 years and not pay any taxes. The deadline for this is the end of the year. So December 31st, 2020 is the penalty-free distribution deadline. So if you haven't taken it by then, don't wait till 2021, because that 10% penalty is likely to be back there. Now, we talked about borrowing, and we talked about taking money out of your IRA just as distributions and not putting it back. And yes, those are options, and those are more lenient now because of the CARES Act. But keep in mind, your account is probably already down because of the market. Yes, over the past few weeks, it's come back up. So maybe not down as much, but down certainly from the end of 2019. So you're taking money out in a down market, which is not necessarily a great idea. And while your money is out of that account, whether you're keeping it out of the account or putting it back over time, it's not earning you money. It's not compounding. Compounding is when your money makes money. So you put $10 into an account and it makes $1. So now next year, $11 is going to earn money, and so on and so forth. So your money, if you keep contributing, is making money for you. So you're stopping that process too, which could, depending how far outside of retirement you are, may not give you a lot of time, whether, if you're in retirement, certainly, or if you're less than 5 years, also not a lot of time to get that money back in and to get it working for you again. So if there are other means, and by no means am I saying, hey, rack up the credit card bill, because I don't think that's a good idea either. But if there are other resources, I do think it does make sense to look at those first. The other idea that you may want to do is, if you are in retirement status and you don't need to take your required minimum distribution this year because the rules are allowing that, you could consider something called the Roth Conversion. So your traditional IRA, your 401k, your 403b, you're not paying any taxes. It comes out of your paycheck. It goes in, tax deferred, it grows tax free, and you pay tax as the money comes out. A Roth IRA is sort of the opposite. You pay the tax now. It's after tax money going in, but then it grows tax free, and then it comes out tax free. And you're not required to take it out as part of your required minimum distributions at retirement. So it has a long runway to really grow. So if this is going to be a low income year for you because you're retired, but you don't need to take money out of your IRA, you could do something that's called the Roth IRA conversion. And again, this is not right for everybody, and I'm not giving really specific advice. This is just a general idea. What happens is you essentially roll money from your IRA into a Roth IRA, and you pay the tax now. And because you're not taking your RMD, maybe you're paying it in a lower tax bracket, and then it grows tax-free forever until you need it. So another idea really on how to take advantage of the CARES Act and how it could relate to your retirement, because it'll then be growing tax-free, and it will also mean you have to take less for your RMDs in future years, which could again, lower your taxes. So go ahead.
I've been receiving RMDs since 70 and a half. Do I still have to take one this year in 2020? If I do, this seems like a penalty on me. I'm 73 now.
You do not have to take it. If you haven't taken it this year, you do not need to take it. If you need the money, take it, because that's what you're living on. But it is waived. The required minimum distribution is waived for 2020. So you do not need to take it or pay and pay tax on that money, unless you do need to take it out. So if you haven't taken it yet and you don't need it, it benefits you not to take it. So we'll do our final poll, which is which of the following best describes you? And this has to do with retirement accounts. So I'm actively contributing to my retirement savings plan. I stopped contributing. I have not been contributing, or I don't have a retirement savings plan. Excuse me. So we'll find out where you are in that, and then talk about a little bit about what that means going forward for your retirement plans. We talked about money coming out. We'll talk a little bit about money going in, because the more you can put in, the more it benefits you, A, by paying less tax now, and B, by having more set aside for retirement. When you get there. It used to be, generations ago, our parents and our grandparents, they had pensions. They worked for the same company for their entire lives, and they got a pension, which means the company was paying their retirement, for as long as they lived post-retirement. It's more on us now to do that. Less companies offer pensions, and we need to rely on IRAs and 401ks and 403bs. So the more you can put in, the more it benefits you really in multiple ways. Yes, ma'am.
Is the RMD waiver for 2020 applicable to IRAs, 401k, and 403b?
Yes.
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 Have they backed off and no longer able to recharacterize the Roth conversions?
No. As far as I know, they have not backed off on that, although they've been talking about, Congress has been talking about throwing that into the various stimulus packages. But what they're talking about, it used to be if you did a Roth conversion and then you did your taxes and said, whoa, that was way too much, I have to pay too much tax, you could put it back into the IRA. A couple of years ago, that ended. And so once you convert, you can't put it back in. So you really need to be precise with your calculation, or error on the low side, and don't put a lot in if you think it's going to cost you a lot on taxes. But again, if you're not taking your RMD and you're going to wait until the end of the year to decide if you want to do a Roth conversion, that's the best time to figure it out, because as you get closer to the end of the year, you know what you've taken for income, all your income sources and what your taxes are going to look like. And then whether it's you or you have somebody prepare your taxes, you can look and figure out which tax bracket you're in and figure out if it makes sense. So poll results, which of the following best describes you? The majority, 71%, actively contributing to my retirement plan. That's great in this environment right now to still be doing that. Second is I've not been contributing, and then I do not, or I've stopped contributing. So if you are contributing and you can contribute, again, not to the detriment of you have bill collectors, calling you and trying to get your credit card debt paid off. But assuming you can still afford to, your cash flow still allows you to, if you're putting money in out of each paycheck that you get into your retirement plan, you're doing something called dollar cost averaging. So as the market went down for that month, down 30%, if you're buying every 2 weeks, you're getting a deal, you're getting a bargain, you're getting it cheap. And as it rises, so you're buying more shares at a lower cost. And then as the market went up over the past couple of weeks, you ended up making money that way. So that's the best way to get into a market that is this volatile, this up and down, is you dollar cost average in every couple of weeks. Also, if your company is still matching, so if they do, let's call it a 6% match, make sure you're putting 6% of your salary into your company retirement plan, because if they're still matching, that's free money. And you don't want to give that up if you don't have to. So if you can at least still cover the match, put that in, and so the company can keep paying you, because they won't give you the match. You have to go first. So if you're not putting money in, they're not going to do the match for you. And then I would say, for those of you within 5 years of retirement, again, if you can still keep contributing, your dollar cost averaging, you're getting the match as well. Continue to do so, but it's probably time to revisit your asset allocation. So, if you're 20 years ahead of retirement, you tend to be pretty aggressive. And, as you get closer to retirement, it should be natural to get a little more conservative so that when the market fluctuates like this, you're not as affected. Yes, you'll be affected, but maybe not as much. I mean, the worst case scenario is you retire the day that this whole thing hit, right? Because then you start needing money at the worst possible time. And if you're at a really risky allocation, that could hurt you a little bit more than others. So just revisit it. I'm not saying you need to make any changes right now in the middle of all this, but look at it. If you have someone that can help you, whether it's somebody in HR or HR has, probably an advisor on your plan that you can call for advice. That's a good idea. Just to reassess your risk and find out, where you should be if you're getting close to retirement. There, and I do have a couple of resources for you. We've talked about some of them. We've talked about mass.gov. You can click on COVID-19 and it really takes you to a whole bunch of information. Again, irs.gov for anything stimulus check related. At the Financial Planning Association, if our website is fpama.org, and we also have a list of certified financial planners that can help as well. So you can go to fpama.org. If you click on Find a Planner, you'll be able to put in sort of the parameters you're looking for in your area and possibly be able to find somebody that will help you there as well. Two quick things about looking for a planner. If that's what you're inclined to do, it's always good to have them be a CFP, a certified financial planner. It means they've gone through the education, they've gone through the ethics, they continue to go through the ethics, and they have the practical experience, and they're a fiduciary, which is really important. A fiduciary means your interest comes before that of the planner or any company or organization that the planner works for. So fiduciary is a good word to ask. CFP is a good credential to have. And that sort of sums up, I think, how it relates to your retirement, the CARES Act. And we can, open it up to some more questions, Shai, if that makes sense.
I have one. It says, maybe not with the CARES Act, but some legislation this year changed the mandatory RMD from 70.5 to 72.
Yep.
Has that been impacted?
Right. So that did happen. So as part of the new tax package last year, it used to be age 70.5. You had to start taking the required minimum distributions. And the reason for this, by the way, is that you've deferred all this tax as you've been working and growing through your career. So now the government wants to get some of that tax money back. So they make you start taking it out a little bit each year once you turn 70.5. So that age has been pushed to age 72 beginning this year. So if you were between age 70.5 and 72 this year, you already were not going to have to take your RMD. Age 72 and beyond, you would have to, but again, for this year, nobody has to. So starting next year, if you're age 72 or above, you'll start to need to take those again.
Another question. If I have been furloughed and not getting an income from my employer, is there any other ways to make small contributions to my 401k using unemployment income? I am 20 plus years away from retirement.
So you need to have earned income to make a contribution. So since you've worked part of this year, you have earned an income. So assuming you've put into your 401k, 403b, whatever you have at your work, and then depending on your earned income at the end of the year, you still may be able to contribute to an IRA. You may be able to open up an IRA and contribute to that, and it still may be deductible, but again, it depends on your earned income for the year and if you're phased out, because there are income limits on that. So it's possible without knowing the specifics, though. I don't know the direct answer for you.
That's all of our questions that I have here in the Q&A box or in the chat box. I don't know if anybody has any last minute questions, but we're 5 minutes from 1. So I'm going to give you all a minute if you have any questions to submit them. While we're waiting, did you want to tell folks how they can get in touch with you or keep up with you?
Yep, sure. You can go to, well, you can find me on the Financial Planning Association website. So I'm the current president this year. So if you go to fpama.org and click on the board of directors, you'll be able to find me on there. And as well as that's a site where if you're looking for a financial planner, you'll be able to go there as well.
All right, it looks like we don't have any other questions. So I'm going to close. If you have any other last words for us, Brad, but thank you so much for joining us. And thank you so much to the financial planners of Massachusetts. You guys are great.
Yeah, I would just say thank you to you again, Shai, and the Department of Economic Empowerment for having us. Again, to Kristen, our executive director, for coordinating all of this too. And just know that, you know, times are different. Times are difficult for some right now. And they're forever changing. It's fluid. So what we talked about today could slightly change going forward. There are always going to be questions. I think Department of Economic Empowerment is doing these talks weekly. So, you know, for sure, check back in. And as we get updated information, we'll relay it to you. And feel free to reach out to us with any questions. Hopefully it was helpful. And, you know, thanks for spending lunch with me.
Thank you all again. Like Brad mentioned, we are a weekly virtual workshop platform. So we will be back next Tuesday to discuss veterans bonuses and how any of those resources might have changed with the coronavirus thing. So yeah, thank you again, and we will talk to you next week.
Thanks. Bye-bye.
Bye, everybody.